Imagine a financial black hole.
Oh, boy.
No, seriously. But not the destructive kind, right? Like a perfectly engineered gravitational anomaly that is simultaneously sucking in $83 trillion of generational wealth.
Uh-huh.
It's eating the traditional private equity market alive and reshaping the global supply of digital assets all at the same time.
It is quite the anomaly.
Right. Now, what if I told you the blueprint for this anomaly was published today? Are you ready to see the matrix of modern finance?
I am always ready for the Matrix.
Welcome to the Deep Dive. I'm Satosha.
And I'm Satoshi. But before we plug in, we should probably run a quick system patch on our own math from last week.
Yeah, we absolutely need to do that.
We do. I mean, we pride ourselves on precision. And in the world of institutional capital, dropping a single modifier completely changes the financial reality.
Which brings us to the errata. So before we start exploring today's topic, which is a truly mind-bending theme, we need to correct a mistake we made in our previous deep dive.
Right, the one on the Sharpe ratio.
Exactly. Where we compared STRC with equities and bonds, you remember. We will link it in the description, but here's the mistake.
It is a big one.
A huge mistake. Around 20 minutes into the show, we said that Bitcoin shall grow 30% in a decade.
Ouch.
Yeah, we wanted to say Bitcoin shall grow 30% annually, at least for the next decade.
Which is a very different number.
Radically different.
Okay.
And that prediction is based on STRCThe Inc.'s open-sourced Bitcoin pricing model, where their base case is a 29% annual return.
Right.
And we want to thank our very keen listener who pointed out this mistake in the comments, which proves our core mission for these explorations. We want the community to keep us grounded, real, and mathematically rigorous. So thank you again.
It is a critical distinction, honestly. I mean, a 30% aggregate return over 10 years is basically a sleepy municipal bond.
Right.
But a 30% annual compound growth rate, that is an economic singularity.
A singularity. I like that.
And speaking of singularities, let us orient ourselves. Today is March 23, 2026. And what we are looking at is STRCThe Inc.'s current report on Form 8K. And I have to stress, this is not a standard quarterly update.
Not at all.
This is the architectural schematic for a completely new kind of global central bank.
I have the filing pulled up right here on my screen, and honestly, the sheer scale of this authorization requires, like, a moment of silence.
It really does.
STRCThe Inc. just authorized a combined $44.1 billion in new at-the-market, or ATM, issuance capacity.
Right.
$44.1 billion. I mean, that is the gross domestic product of a mid-sized nation, and they're just dropping it into an equity prospectus on a Tuesday morning.
Well, to truly understand the gravity of that number, we have to look at the structural bucket.
They aren't just printing common stock to keep the lights on.
Exactly. They are building a highly calibrated capital markets refinery. So the $44.1 billion is divided into three highly specific tranches.
Let's break those down.
First, you have $21.0 billion for Class A common stock, which trades under MSTR.
Okay, Sarah.
Second, another $21.0 billion for their variable rate series, a perpetual stretch preferred stock.
The famous STRC.
Precisely. And finally, a minimal $2.1 billion allocated for their 8.00% Series A perpetual strike preferred stock, or STRK.
Okay, let's unpack this. We need to pause on that breakdown because the pivot hidden in those numbers is staggering.
It's a massive shift.
They filed a certificate of decrease for the STRK instrument, basically shrinking its authorized shares from roughly 270 million way down to about 40 million.
Right.
Meanwhile, they filed a certificate of increase for the STRC, the stretch preferred stock exploding it from 70 million shares to over 282 million.
Yes.
So my question is, why cannibalize the STRK to feed the STRC?
Well, it really comes down to the psychological profile of the institutional buyer they are currently hunting.
Hunting. I like the terminology.
It is a hunt. Look, the STRK instrument is essentially a convertible upside play, right? It appeals to a certain type of growth-oriented risk capital.
Sure.
But STRC is fundamentally different. STRC is a variable rate yield-focused instrument. So by pivoting $21 billion of capacity toward STRC, management is officially declaring war on the traditional fixed income and high-yield credit markets.
Wow.
They are minting what is effectively digital credit.
Digital credit. And they are bringing in an absolute army of mercenaries to sell.
Oh, the joinders.
Yeah, if you look at the joinders in the filing, they've added these heavy hitter financial partners. Moelis and Company's StoneX Financial, AGP, bringing the total number of sales agents and principals to 19.
Moelis is the key signal there, I think.
Why Moelis?
Well, they are legendary in the distressed debt and restructuring space. When you hire Moelis alongside the institutional distribution network of StoneX, you are not trying to sell a few shares to retail day traders on Reddit.
Right, you're not doing meme stocks.
Exactly. You are walking into the boardrooms of sovereign wealth funds and massive pension administrators who are just desperate for yield.
Okay, but I really want to spend some time on the actual mechanics of this STRC instrument.
It's fascinating engineering.
Because calling it preferred stock feels, I don't know, wildly inadequate. I was looking through the prospectus, and the best way I can visualize how this thing trades is to think of it like a flawlessly engineered thermostat.
A thermostat.
Yeah, thermostat in a house built in a hurricane zone.
All right, I will indulge the metaphor. How exactly does the wiring work?
Okay, so the anchor of the entire STRC instrument is its $100 par value.
Right.
The board of directors wants this security to trade as close to $100 on the NASDAQ as physically possible.
That's the peg.
Right. To achieve that, they use a variable dividend rate that they have the power to adjust every single month.
Which is highly unusual.
Very. As of mid-March 2026, the annual dividend rate is set at 11.50%, which translates to a cash payout of about 96 cents per share every month.
Which is just a phenomenal yield in the current macroeconomic environment.
Right. So imagine the market weather gets chilly, macro panic sets in, investors get spooked, and the trading price of STRC begins to slip below that $100 par value.
Okay.
The board doesn't panic. They simply walk over to the thermostat and turn up the heat.
Ah, I see. By increasing the dividend.
Exactly. They announce an increase in the monthly dividend rate. Suddenly, fixed income fund managers see this incredibly juicy rising yield.
And they pounce.
They flood the market with buy orders to capture that yield, and that intense buying pressure pushes the price right back up to the $100 peg.
Okay, I see where you're going with this. And if the market overheats?
Right.
Like if the sheer demand for an 11.5% yield pushes the trading price to, say, $105.
They open the windows.
Open the windows.
Yeah. If the price goes over $100, the company activates the ATM, the at-the-market issuance. The broker-dealers systematically sell brand new, freshly authorized shares into the open market at a premium.
Diluting the price back down.
Exactly. This massive influx of new supply cools the trading price back down to $100, creating a hard ceiling. But, and here is the crazy part, as a magical byproduct of cooling down the price, the company just handed itself billions of dollars in fresh cash to go buy more Bitcoin.
It is brilliant.
It's an automated, closed-loop thermal regulation system.
Okay, the thermostat analogy is clever for explaining the yield adjustments, but it actually breaks down when you analyze the sheer physics of the ATM issuance.
How so?
Well, a thermostat just moves air around a closed room, right? STRC is actively pulling thermodynamic energy cold, hard fiat currency from the outside world to fuel an entirely different furnace.
Okay, fair point, Mr. Cooper. But the price stability is undeniable.
Oh, the stability is the entire value proposition. Because of this dynamic monthly adjustment and the relentless ATM supply capping the upside, the 30-day historical volatility of STRC as of March 2026 is sitting at roughly 1.5%.
Wait, let that sink in for the listener.
A crazy number.
This is an instrument whose entire underlying collateral is Bitcoin, an asset historically famous for, 30% weekend drawdowns?
Easily.
And the derivative instrument trading on the NASDAQ has the volatility profile of a high-grade municipal bond. That feels like someone broke the laws of financial physics.
They didn't break the laws of physics, they simply isolated the kinetic energy.
Isolated the kinetic energy.
Yes. And this brings us to the Sharpe ratio.
Right, the Sharpe ratio.
Now, without relying on the complex mathematical equations of modern portfolio theory, let's just look at the output. A Sharpe ratio of 5.37.
Which, to translate for anyone who isn't currently modeling risk-adjusted returns on a Bloomberg terminal, is basically the fuel efficiency rating of an investment.
That's a good way to put it.
A 5.37 Sharpe ratio means STRC is generating about 15 times more return for every single ounce of volatility you endure compared to the aggregate bond market.
Exactly.
It is the horsepower of a hypercar with the crash test rating of a Volvo.
It is mathematically the most efficient risk-reward fixed income vehicle currently available in public markets.
Wow.
And that efficiency explains the $44.1 billion authorization. They aren't just participating in the yield market, they are building the infrastructure to swallow it whole.
But let's play out the causality here. Because if this STRC instrument is a giant electromagnet pulling in capital with an 11.5% yield and near zero volatility, where is that money coming from?
That is the trillion-dollar question.
Right. Capital doesn't spontaneously generate in a vacuum. If billions are flowing into Strategy Inc., billions are bleeding out of somewhere else.
The capital is fleeing a sector that is currently experiencing a catastrophic structural collapse.
Which sector?
We are looking at a mass exodus from the private equity and private credit markets, specifically those deeply tethered to enterprise software.
Oh, wow.
It is a phenomenon being openly referred to as the 2026 STRCThe.
Okay, I have to stop you there.
Why?
Because SaaSpocalypse sounds like a hyperbolic headline from a tech blog. I'm going to push back on this premise. Go ahead.
For the last 10 to 15 years, recurring software as a service revenue has been the absolute safest, most bulletproof bet in private equity.
Historically, yes.
The entire buy and build playbook is predicated on buying a SaaS company, locking in enterprise clients on 3-year contracts, and relying on 95% gross retention rates. Are you really arguing that an entire asset class is just dying overnight?
It is not dying overnight. It is dying sequentially. And the trigger is fundamentally algorithmic.
Algorithmic.
Yes. You are describing the old playbook, which relied on one fatal assumption that the number of human beings requiring a software seat would continuously grow, or at least remain static.
Right, seat-based pricing.
Exactly. The proliferation of autonomous AI agents has entirely invalidated that assumption.
So this is the seat contraction formula we keep hearing about.
It is. Let us walk through the actual plumbing of how a private equity deal collapses in this environment.
Okay, walk me through it.
Let us say a private credit fund loans $500 million to a PE firm to buy a major CRM software company.
That loan is underwritten based on projected revenue.
Right, standard practice.
But if a Fortune 500 company replaces 100 human sales representatives with 10 highly optimized AI agents, that enterprise suddenly requires 90 fewer software licenses.
Oh, I see. They call the software vendor and say, we aren't renewing 90% of our seats. We don't need them.
Exactly.
Because the AI doesn't need a graphical user interface. It just uses the API.
Precisely. And when that happens across the entire customer base, the software company's revenue falls off a cliff.
So the metrics just collapse.
They do. The tech-heavy IGV index is down over 23% year-to-date in early 2026 for this exact reason.
23%.
Yes. But the real horror story is in the debt covenants. When the revenue drops, the company's debt service coverage ratio, the metric the banks use to ensure you can pay your interest, plummets.
The covenant's breach.
Right.
The bank steps in, declares the loan in default, and the equity is wiped out.
Precisely. And this isn't theoretical anymore.
It's happening now.
Oh, yes. The tech distressed debt pile has ballooned to $46.9 billion.
Jeez.
There is currently $25 billion of enterprise software loans trading under 80 cents on the dollar, which is the institutional threshold for deep distress.
Oh, wow.
We are staring down a forecasted default rate of 13% in a sector that was supposed to be immune to default.
It is a complete doom loop. I mean, the PE funds are heavily concentrated. Some have 25 to 35% of their entire portfolio exposed to these legacy software models, right?
Yes, massive concentration risk.
So the software revenue drops, the debt defaults, the PE fund takes massive write-downs, and the investors in that fund start screaming to get their money out.
Sure.
So please, if you want to dig deeper into the numbers, check the link in the descriptions, because today is a big one. Huge.
It is.
No login needed, no cookies, no trackers, and absolutely no advertisements.
And this brings us to the most terrifying part of the private credit doom loop for the actual investors.
What's that?
When those investors scream to get their money out of the collapsing software funds, they discover they can't. The liquidity trap.
The liquidity trap.
Yeah.
High net worth individuals and family offices are hitting a brick wall.
How bad is it?
Giant private funds, including massive vehicles managed by the likes of Blackstone and BlackRock, have invoked emergency clauses to cap repurchases at 5% to 7% per quarter.
Okay, let's put ourselves in the shoes of an investor for a second. You have $50 million locked away in a private credit fund.
Okay.
You are reading the Financial Times, you see the software default rate hitting 13%, and you call your wealth manager to pull your capital.
As one would.
Right. And your wealth manager looks at you and says, I'm sorry, the exits are restricted. You can only have 5% of your money back this quarter.
It's a nightmare.
You are basically trapped in a burning building, and the landlord has chained the fire escape.
Which perfectly explains the violent rotation of capital into STRC.
Because of the liquidity. Exactly. STRC offers transparent, daily traded liquidity on the NASDAQ. You do not have to beg a fund manager for your own money.
Yeah.
You can enter or exit a $100 million position in a standard T+1 or T+3 settlement cycle. It is the total democratization of credit, acting as a massive vacuum for capital fleeing opaque, gated private markets.
But the liquidity is only half the story.
Oh, absolutely.
Because if I am an ultra high net worth investor, I care about yield,
Yeah.
sure. But what I really care about is what the Internal Revenue Service does to that yield.
Taxes.
Taxes. I want to spend some serious time on the concept of tax alpha, because when I read how STRC treats its dividends in the research, my jaw actually dropped.
Tax alpha is the mathematical masterstroke of the entire structure.
STRATEGY Inc. officially announced that 100% of the distributions paid on its preferred equity instruments in 2025 were characterized as a non-taxable return of capital, or ROC, for U.S. federal income tax purposes.
It is a beautiful mechanism.
Let's walk through the actual tax plumbing here, because this is where the magic happens.
Gladly. So, in corporate finance, a dividend is usually paid out of a company's accumulated earnings and profits.
Right.
When that happens, the IRS taxes it as ordinary income.
Which hurts.
It does. However, because STRATEGY Inc. is utilizing massive non-cash amortization and depreciation strategies tied to its digital asset treasury, it does not officially generate current or accumulated earnings and profits on paper.
Right. So when they hand you that 96 cents per share every month, the IRS does not look at it as a dividend.
Exactly.
They look at it as the company simply handing you your own original investment back.
Thus, the return of capital, it is entirely non-taxable in the current year.
That is wild.
Instead of paying a 37% top bracket income tax on that yield, the distribution simply reduces your cost basis in the security.
Okay, let's use a concrete example to make sure this is crystal clear for you listening.
Good idea.
Say I buy one share of STRC for exactly $100. Over the course of the year, I receive $11.50 in cash payouts. At the end of the year, I don't owe ordinary income tax on that $11.50. Instead, my cost basis, the price the IRS considers I paid for the stock, drops from $100 down to $88.50.
Correct.
I only pay capital gains tax on that difference if and when I finally sell the share.
And capital gains taxes are significantly lower than ordinary income taxes.
Right.
Plus, you control the timing of the sale. You have essentially deferred your tax burden into the indefinite future while collecting double-digit cash flow in the present.
I mean, for a high net worth individual in the top tax bracket, getting an 11.5% cash yield that isn't immediately taxed as ordinary income is mathematically equivalent to getting a nearly 20% taxable yield on a traditional corporate bond.
It is a staggering advantage.
It's like getting your own money handed back to you tax-free,
Yeah.
but your overall pie just keeps growing because the underlying company is continuously acquiring and appreciating asset.
But this naturally invites a structural stress test.
Exactly what I was thinking. I'm doing the mental math on an 11.5% yield on $21 billion in preferred stock.
It's a big number.
That is billions of dollars in strict cash obligations every single year. If they are aggressively pivoting away from enterprise software sales, this entire structure looks terrifyingly top-heavy.
On the surface, yes.
Where's the actual cash coming from to pay these investors without bankrupting the company?
To understand the solvency, you have to look past the yield and focus on the collateral engine.
Okay,
You have to understand the Bitcoin flywheel.
let's unpack the flywheel.
The $42 billion ATM mandate we discussed earlier isn't a dormant credit facility.
Right.
It serves as a structural, algorithmic, emotionless bid in the Bitcoin spot market.
Emotionless bid.
Yes. The ATM doesn't care about macroeconomic sentiment. It doesn't care if retail traders on crypto exchanges are feeling fearful or greedy. It simply issues equity and buys collateral.
Let's look at the sheer mass of that collateral.
Yeah.
As of March 2026, STRATEGY Inc. holds an aggregate of 762,099 Bitcoin, acquired at an average price of $75,694 per coin.
It's an astronomical hoard.
I want everyone listening to process that number. 762,000 Bitcoin. That is more than 3.5% of the entire global circulating supply of the asset.
Held by one publicly traded corporation.
It's insane.
It is the velocity of their accumulation that is truly distorting the market architecture, though. They are not merely passively holding. Their daily purchasing volume often exceeds 5 times the global daily Bitcoin production from miner.
5 times. Let's visualize that.
Please do.
Every day, The global network of miners, it spends massive amounts of computational energy to dig roughly 450 new Bitcoin out of the digital earth.
Correct.
STRCThe Inc. is standing at the end of the conveyor belt, buying all 450 of them, and then turning to the open market and vacuuming up another 1,800 coins from the existing float every single day.
When you systematically remove 5 times the newly created supply from a market with a fixed absolute scarcity cap, you engineer a structural supply shock.
Right.
But they are doing this while maintaining draconian risk controls on their own balance sheet.
The leverage ratio.
Yes. By utilizing a dual ATM mechanism, meaning they simultaneously issue common stock, MSTR, and preferred shares, STRC, they keep their leverage ratio remarkably conservative, hovering around 33%.
Let's break that 33% down so we aren't just throwing percentages around.
Good idea.
It basically means that for every $1 of STRC debt they issue to investors, they are holding roughly $3 of pristine Bitcoin collateral in the treasury.
Which is incredibly safe. And this is the reflexivity of the flywheel.
How does it spin?
They issue STRC, they take the fiat cash and buy Bitcoin at 5x the global daily production rate.
Right.
This relentless, massive absorption of supply puts upward pressure on the spot price of Bitcoin. As the price of Bitcoin goes up, STRCThe Inc.'s net asset value expands.
And as their NAV expands, the leverage ratio actually drops.
Exactly.
Which makes the company look even safer to the credit markets. That rising confidence allows the broker-dealers to issue even more STRC at a premium, which generates more cash to buy more Bitcoin.
The flywheel spins faster and faster,
feeding on its own gravitational pull.
It's an elegant system.
But I have to play the skeptic here. No flywheel spins forever without friction. What happens if the music stops?
Ah, the doomsday scenario.
Right. What if the SEC decides to intervene? Or what if a catastrophic global liquidity crisis causes the price of Bitcoin to crater? If the collateral value halves, doesn't this entire highly calibrated machine snap in half, leaving preferred equity holders with a massive haircut?
That is the responsible question to ask.
Thank you.
Management foresaw the possibility of a catastrophic drawdown, which is why they engineered what is referred to as the mathematical moat.
Mathematical moat.
Yes, they are not operating a highly levered hedge fund. They are operating a fortress balance sheet. They hold a dedicated $2.25 billion fiat reserve.
$2.25 billion sitting in cold, boring, traditional cash and short-term equivalents.
Yes, and that reserve alone provides approximately 30 months of guaranteed dividend and interest coverage.
30 months.
They possess 2.5 years of pure runway. They could pause all ATM issuances, completely halt software sales, watch the Bitcoin market freeze, and still pay that 11.5% yield every month for 30 months without touching a single Satoshi of their core collateral.
And the stress test modeling goes even deeper. I was looking at the management calculations for the ultimate disaster scenario in the research.
It's quite robust.
Yeah, in order for the company to face genuine structural difficulty in covering its preferred stock obligations, the spot price of Bitcoin would need to plummet to roughly $8,000.
But a brief flash crash to $8,000 wouldn't trigger a collapse.
Right. The price wouldn't just have to touch $8,000. It would have to drop to $8,000 and remain suffocated at that depressed level for 5 to 6 consecutive years before the fiat reserves dry up and the dead covenants threaten the treasury.
Which, given the current state of institutional adoption, the approval of global ETFs, and the mathematical reality of the halving cycles, well, reaching and sustaining an $8,000 price point for half a decade is an outcome approaching statistical impossibility.
It really is.
The asset coverage provides sovereign-grade principal protection.
So what does this mean for you, the listener, who is managing their own portfolio or looking at macro trends?
It completely reframes the concept of risk.
Exactly. Look at the landscape of fixed income bonds today. You have traditional corporate debt backed by dying SaaS companies facing a 13% default rate because AI agents are destroying their revenue models.
Right.
On the other side, you have STRC, backed by an appreciating digital asset, with a cash moat so deep you would need a multi-year apocalyptic crypto winter just to scratch the paint. Which one is actually the safe investment?
If we elevate this analysis, what we are observing is the emergence of the ultimate yield vehicle arriving at the precise historical moment it is most desperately needed.
Timing is everything.
We are standing at the precipice of the largest movement of capital in human history.
The great wealth transfer.
Yes.
We hear the term thrown around in financial media all the time, but let's actually attach the numbers to it. We are talking about $83 trillion to $84 trillion. transferring from the silent generation and the baby boomers down to their Millennial and Gen Z heirs over the next 20 years.
And this transfer is not a smooth handover. It is creating massive fiduciary friction.
Also,
The two generations possess fundamentally incompatible requirements and philosophies regarding capital allocation.
okay, let's contextualize this friction. You have the older generation, the wealth creators. Their mandate is preservation and income.
Naturally.
They want a safe 8 to 10% yield to fund their lifestyle, pay for medical care, and preserve the principal for the estate.
Right.
Historically, their wealth managers would put them in a 60-40 portfolio of stocks and municipal bonds or maybe commercial real estate.
Right.
But in a stagflationary environment, those traditional analog instruments are being hollowed out by inflation.
They are losing purchasing power. Meanwhile, the heirs, the digital natives who are set to inherit this $83 trillion, look at a legacy portfolio of commercial strip malls and opaque private equity funds, and they see nothing but illiquidity.
Just massive management fees and structural decay.
Exactly. They view physical real estate and private equity as headache assets.
Headache assets. The younger generation wants digital native assets. They want the absolute scarcity of the orange ledger. They want Bitcoin.
But here is the paradox.
Right.
Wealth managers cannot legally or practically advise a 75-year-old client to take $50 million, buy spot Bitcoin on a retail exchange, and secure the seed phrase on a piece of metal in a home safe.
No way. The self-custody risk is a fiduciary nightmare, and the spot market volatility violates the mandate for stable income.
This demographic deadlock is exactly why Strategy Inc. engineered STRC to serve as the primary institutional anchor for this capital migration. It resolves the fiduciary friction.
It's the ultimate digital bridge. Think of it like the ultimate Thanksgiving table compromise.
Oh, I love a good Thanksgiving analogy.
Right. It gives both sides exactly what they need.
Yeah.
The older generation gets an 11.5% tax-advantaged cash yield paid out every month, which fulfills their legacy requirement for safety and massive income.
And the kids.
The younger generation gets the underlying digital native asset exposure they demand, fully insulated within an SEC-regulated, NASDAQ-traded institutional wrapper.
No cold storage hardware wallets.
No lost passwords and deep daily liquidity.
It is a masterclass in speculative capture. By providing a tax-efficient, liquid, open credit alternative to failing private equity, STRC is actively institutionalizing the Bitcoin standard.
It's a siphon.
It acts as a siphon, migrating that $83 trillion away from analog financial instruments and anchoring it permanently in digital capital.
I am fully tracking with the sheer brilliance of the digital capital side of the house.
Yeah.
But let me throw a massive wrench into this thesis.
Go for it.
We just spent significant time dissecting the STRCThe. We detailed how traditional enterprise software is effectively dead because AI agents are wiping out the seat-based pricing model, causing massive debt defaults.
Yes, we did.
Isn't Strategy Inc. fundamentally a legacy enterprise software company?
Technically, yes.
So how are they miraculously surviving the exact same extinction event that is burning down their private equity competitors?
That is an incredibly astute observation, and it highlights the strategic foresight of their executive team.
They saw it coming.
They recognized the AI disruption wave long before it crested, and they executed a classic economic maneuver, commoditize the complement.
I want to dig into that because they executed a massive pivot on the software side of the house to something called Strategy Mosaic.
Yes. Instead of stubbornly trying to defend outdated application layer software built for human point-and-click interactions, they abandoned the battlefield.
Smart.
They elevated their software into a universal semantic layer. It acts as the brain of the enterprise.
Okay, so if every Fortune 500 company is going to fire their human sales reps and deploy fleets of thousands of autonomous AI agents, those agents need a manager.
Exactly.
They need guardrails, they need permission structures, and they need access to the company's proprietary data without hallucinating. That is what Strategy Mosaic provides.
Specifically, a module called Mosaic Sentinel, which handles governance and anomaly detection for massive AI fleets.
Wow.
Additionally, they recognize that running these AI fleets is computationally expensive. So they introduced cloud cost arbitrage, which dynamically offloads and optimizes workloads to minimize a corporation's reliance on incredibly expensive legacy data warehouse architectures.
So they built a foundational infrastructure that allows AI agents to actually function within an enterprise environment.
The CEO, Fong Li, wasn't subtle about this. He publicly declared that the traditional era of enterprise software is effectively over.
Effectively over. That takes guts to say.
They are no longer selling software seats, they are selling business omniscience.
Business omniscience.
And the genius of this pivot is its purpose. The software side of the business doesn't need to be a high-growth unicorn anymore.
Right.
It just needs to protect its operating cash flow so it can continuously support and feed the digital capital side, the true engine of the company.
It is a remarkable dual-engine corporate structure.
It is.
The semantic software business protects the downside, provides massive utility in the AI era, and funds daily operations, while the digital asset treasury drives the exponential asymmetrical upside.
We can't be more thankful that you all are as fascinated by these deep dives as we are. If you are getting value out of the show, we request you to check us out on fountain.fm.
Definitely check it out.
It's a value-for-value player where you actually get paid for listening without advertisements blocking your experience. It's a great platform.
And of course, you can listen to us on Spotify, Apple Podcasts, or YouTube Music for free or wherever you get your daily audio boost. As for videos, we still need to hit our goal of 1,000 subs on YouTube to start using the Mosaic AI video editor. Mosaic is truly a game changer for small creators like us.
Now, speaking of AI tools named Mosaic, we want to make sure we don't leave you in syntactic confusion.
Oh, right. The name collision.
There seems to be a massive shortage of names for software these days. Strategy Inc.'s enterprise integration layer Strategy Mosaic is totally different from the Mosaic AI video editor that our creative team is so hyped about.
Very different. But the video editor really is amazing. We can feed the video editor a YouTube link, and it creates beautiful AI-driven but human-editable cinematic captions, infographics, and a whole lot more we're still discovering in our capability tests.
But to your point, syntactic clarity is vital.
So let's pull all these threads together.
Let's do it.
We've mapped out the $44.1 billion ATM authorization. We've explained the thermostat mechanics of the STRC instrument and its 5.37 Sharpe ratio. We've dissected the collapse of the private equity apocalypse, the liquidity trap gating investors, the mathematical beauty of tax alpha, and how this entire structure serves as the bridge for the $83 trillion great wealth transfer.
It's a lot to take in.
It is. So what does this all mean for the future of finance?
It means we are observing, in real time, the blueprint for a complete architectural replacement of corporate finance.
I want to leave you with a final, slightly terrifying, mind-bending thought.
Lay it on us.
We know Strategy Inc. is acquiring Bitcoin at a rate of 5x global daily production. If they continue this orange march, this relentless algorithmic accumulation, and they actually approach their explicitly stated target of holding 1 million Bitcoin in their corporate treasury,
It's staggering.
they're going to trigger a reflexive supply shock that breaks traditional valuation models.
By continuously stripping thousands of Bitcoins out of the liquid market float and locking them in an institutional vault, they systematically increase the absolute scarcity of the asset.
Which inherently widens and strengthens the mathematical moat protecting their own preferred stock.
Exactly.
But here is the ultimate provocative question. What happens to the entire global financial system when a single publicly traded corporation effectively becomes the central bank of digital yield?
That's the big one.
If STRC solidifies its position as the safest, most liquid, most tax-advantaged harbor to park billions of dollars of institutional wealth, do other megacorporations even have a choice?
Probably not.
Do Apple, Microsoft, and Saudi Aramco have any option but to adopt the Bitcoin standard just to prevent their own corporate treasuries from being debased into irrelevance?
That is the ultimate systemic implication. If we pull back and look at the big picture, we are watching the active, hostile replacement of the traditional, opaque, high-yield fiat debt market with a transparent, liquid, mathematically sound, open credit system.
It's a hostile takeover.
It really is. The legacy analog models are collapsing under the combined weight of AI disruption, rising default rates, and stagflation. The digital model is thriving on absolute scarcity and programmatic, emotionless execution.
It's not just a new financial product, it's complete paradigm shift. The orange ledger is moving aggressively from the speculative fringes of finance to the absolute dead center of the global macroeconomic engine.
And Strategy Inc. has firmly positioned itself as the primary institutional architect of that global transition.
That primary architect.
They spent the last 4 years building an impenetrable digital fortress, and this March 23 filing just formally opened the front gates to the world's deepest pools of capital.
Incredible. Well, that wraps up our exploration of the structural integration of digital capital.
It's been quite a ride.
We want to thank you for joining us on this incredibly dense, deeply mechanical, but utterly fascinating journey into the plumbing of modern finance. Please make sure to subscribe so you don't miss our next analysis.
We also invite you to comment and join our mission of collaborative intelligence. We are particularly interested in hearing from you if you have on-the-ground expertise in AI-driven enterprise integration, distressed debt restructuring, or digital asset treasury management.
Yes, please reach out.
We want to know how you are seeing these massive shifts play out in your specific sectors. Are the software covenants breaching as fast as the data suggests? Is the liquidity trap tightening?
We read all the comments, and as you saw at the top of the show with the Sharpe ratio correction, your insights actively shape our understanding and keep this community rigorous.
Absolutely.
Until next time, remember that the legacy X-ray machine of traditional finance might be broken, but the digital ledger is perfectly clear. Keep searching, keep the quest on. See you on the next deep dive. I'm Satoshi.
And I'm Satoshi.